Welcome back to the Deep Dive. Today, we're tackling a real classic in the investing world.
Ah, the big one. Growth versus value investing.
Exactly. For years, it feels like you had to pick a team, didn't you? Are you chasing that next big thing or hunting for those overlooked bargains?
It often gets framed as this sort of binary choice.
Right. But we've been digging into a key source that offers maybe a more nuanced take.
Yeah, it definitely moves beyond just picking a side.
So our mission today, break down these two approaches, really get what makes them tick.
And see what our research actually suggests about whether one truly comes out on top for you, the listener.
Okay, so let's lay the groundwork. How does our source actually define these two? Maybe start with growth.
Sure. So growth investing, fundamentally, it's about companies with really high future potential.
Not just growing fast now, but expected to keep accelerating.
Precisely. Think accelerating revenues, maybe grabbing more market share, or even just disruptive innovation, something that promises significant future earnings.
So maybe valuing them differently too, like not always on current profit.
Exactly. Sometimes metrics like price to sales come into play because, the big profits might still be down the road. They're investing in that future story.
Got it. Okay, so how does value contrast with that?
Well, value investing is almost the opposite focus. It's all about finding stocks that are trading below what they're really worth, their intrinsic value.
Looking for a bargain, basically.
Kinda, yeah. But based on solid fundamentals, strong balance sheets, maybe consistent cash flow, perhaps a low price to earnings ratio compared to similar companies.
So less about the exciting story, more about the current financial health.
Right. It's like finding that reliable, solid car that's just priced incorrectly by the market for some reason. You got to look under the hood, dig into the financial statements to spot that hidden value.
Okay, that distinction is clear. Growth looking forward, value looking at present worth. So the million-dollar question then, is one actually better?
Yeah, that's what everyone wants to know, right?
It feels like the core of the debate. What does our source say?
Well, the source pretty much confirms what a lot of experienced investors already feel deep down.
Which is?
Neither growth nor value is universally superior. It's just not that simple.
Okay, not a huge shock maybe, but why is that important?
The real insight is how tempting it is to jump ship on a strategy when it's having a bad run.
Chasing performance.
Exactly. People often bail right before that strategy about to have its moment again because the market shifted. It's less about the horse, more about understanding the waste track,
So the better strategy depends on context.
Absolutely. Success really hinges on a few things. Prevailing market conditions are huge bull, or bear market makes a massive difference.
And personal factors too, I assume.
Definitely. Your own financial goals, your timeline, and maybe the biggest one, your personal tolerance for risk. What works brilliantly in one economic climate might really lag in another.
Okay, so if there's no single winner, and it depends on the market and you, what's the practical advice? What does the source suggest investors actually do?
This is where it gets really strategic. The core recommendation is actually to blend both approaches.
Blend them. Okay, some might think that sounds like trying to mix oil and water. No. How does that work effectively?
That's a fair question. It's not about just randomly mixing, but strategically combining their strengths for balance.
Like building a team.
Yeah, that's a great analogy.
Yeah.
You wouldn't build a football team with only attackers, right? Or only defenders.
No, you need both, depending on the game.
Exactly. You need growth for the potential attack and upside, and value for the defensive stability.
Right.
You adjust the mix based on the game or, the market conditions.
Okay, I see. So the blend itself gives you advantages. Growth provides that upside, especially when the market's booming and rewarding innovation.
Captures that potential for big returns.
But then when things get shaky or markets turn down,
That's where value steps in. Those fundamentally sound, perhaps undervalued companies, they tend to hold up better. They provide stability, acting like a ballast when things get volatile.
so it's by getting the best of both worlds, potentially smoothing out the ride.
Precisely. Which leads to the crucial takeaway for you, the listener.
Which is?
Know your strategy. Seriously. Define what blend actually makes sense for your goals, your risk appetite. And then, this is key, stay consistent.
Don't get spooked by short-term noise.
Exactly. Don't let the latest hot trend or market panic derail a plan you've carefully considered for the long term. Patience and sticking to your guns are just as vital as picking the strategy itself.
That makes a lot of sense. So wrapping this up, the real task for you listening is to think about this personally, given whatever today's market conditions are.
And they're always changing.
Right. How could blending growth and value specifically benefit your approach right now? And maybe think about this. What aspect of your own risk tolerance, when you really examine it, might actually surprise you?
Yeah, how does it align with both that potential for high growth and the need for that value-driven stability? Something to definitely mull over.
Indeed. Plenty to think about until our next deep dive.